Okay, we are going to go through the first lesson of Chapter 8. This one is on notes payable. It's pretty straightforward. Basically, we have decided to borrow some money, usually a larger amount for more than just a 30-day, we'll pay you in a couple of weeks type situation. So as you can see here, cash receipts journal, we're receiving cash, okay, and we're going to keep track of it with a notes payable account for a credit. Example, March 8th, signed a 180-day 8% note, $25,000. Okay, we received cash, so it is a receipt, so we have an R98 as our source document. The 180 days is when it comes due. The 8% is the amount of interest that we're going to have to pay, and those are things that we'll use and calculate when we're getting ready to pay that back. Okay, but just to record the notes payable, it's pretty straightforward. Okay. We will also be calculating the maturity date. So for example, in that it was a March 8th, what's 180 days later? When is that actually going to be due? So we're going to actually do the calculations to find out when the due date is. Okay, and then when we pay it, in our simple situation, when we pay it, we're going to pay the interest at the time that we pay the note back. Okay, so this is 180 days later. We're going to pay the note back with the 8% interest? The 8% interest that we owe. So then at this point, we'll calculate that interest as well. Okay, and that would be what we're going to have to adjust for is the time frame. So 8% is for the entire year. So how much will we actually have to pay just for the 180 days that we had the loan? Okay, and then one more little section in this lesson is just having a line of credit. A line of credit means you've kind of gotten a pre-approval to be able to borrow money, and you don't have to go through the longer process of signing paperwork if you think you might need cash quickly. You've kind of been, like I said, pre-approved, and then you can just go in and pull that cash out pretty quickly at that point. A bank can give you a line of credit. You don't pull it all out initially. You just pull out what you might need as you go through. All right, so working together 8-1. The first thing that we're going to do is just journalize 3 different notes. A notes payable on June 4th, July 15th, and then a line of credit on December 6th. All right. All right, so June 4th, signed a 90-day note, 10% interest, Second National Bank, $5,000. We don't need to know the interest or the days right now. This is just recording the receiving of the cash. So June 4th, 2018. This is a notes payable. Receipt number 223. It was $5,000. Okay, so we're going to owe $5,000, and we have received cash $5,000. So it's cash debit and a payable credit, increasing our liabilities. Then on July 15th, we took out another note with a different bank. This one's 120 days, 8%, $8,000. Receipt 240. Okay, again, $8,000. And we get that cash. And then on December 6th, this is a line of credit. We've had the line of credit, kind of like I said, pre-approved, but we decided on December 6th that we needed some of that, and we didn't have time to go in and actually do the paperwork for a loan, so we're going to use our line of credit. And the bank will have terms on percentage rates, and it's usually not a set one. It depends on when you decide to pull it out and pay it back is when we'll be concerned about the interest rate. It'll depend on the market. Okay? All right, so that takes care of recording our cash receipts for those payables in line of credit. Then number 2 says to calculate the maturity date of each note payable and the total amount of interest due at the maturity date. So this is number 2, which is on the back. All right, so here, June 4th is our due date. Okay, we don't really need to know this for now, but we're just going to go ahead and put that this was a 10% loan, 10%, and 90 days. Okay, so it was a 90-day loan. What we have to figure out is when is this due. So from June 4th to the end of June, which is June 30th. Okay, now how many days are in each month? That's something that you're going to have to kind of remember. And to help you remember that, or what I use, is the knuckles. And some of you may know doing the knuckle counting. So basically, if you take your knuckles and you start here, every time you hit a knuckle, that's a month with 31 days. So January, February doesn't have 31. March has 31. April, May has 31. June, July has 31. And then you stay up here twice. August has 31. September, October, November, December has 31. So if you need a way to figure out how many days are in each month, that's what I have to go do sometimes if I don't recall it offhand. All right, so June 30th through June 4th, basically 30 minus 4 is 26. Okay, so 90 minus 26 means that when we hit June 30th, we still have 64 days remaining. Okay, so 90 minus 26 equals 64. All right, then we have July. Okay, July has 31 days. If you need to count your knuckles, you can do that. So 64 minus 31 equals 33. So at the end of July, we still have 33 days on that note. And then August was also 31 days. So 33 minus 31 means that there's only 2 days left. So that'll get us through September 1st and 2nd. So the due date is September 2nd. Okay? So again, just real quick with the next note, July 15th, I'm going to go ahead and put that this is 8% because we'll need it in a second. We don't really need it right now. And this was a 120-day note starting on July 15th. So for the month of July, July 15th through the 31st, 31 minus 15 equals 16. So there's 16 days from that month. 120 minus 16, 104. August, 31 days. 104 minus 31, 73. September, 30 days. 73 minus 30 is 43. October, 31 days. 43 minus 31 is 12. And then for November, that means we're going to go from November 1st to the 12th. to get the 12 days down to 0. I guess you should put 2 and 0 up there. And so we know that this is due November 12th. Okay, so now we know when they're due. Now we need to know how much interest we're going to have to pay. Right down here. Zoom in a little bit. Oh, maybe not. Okay. All right. So now we just got a little calculation here. Our June 4th note was $5,000, and it was 10% interest. So our principal. Okay, principal is how much we borrowed. The principal of our loan. Our interest rate is 10%. Anytime anybody gives you an interest rate, that is always given to you as an annual interest rate. So you're going to oftentimes have to adjust to break it down into months if we're trying to figure out anything. And in this case, we're actually breaking it down into days, and then applying that to the actual principal. Okay, so so we have the principal, we have the interest rate, and then time is a fraction of the year. So this was a 90-day note. Okay, and notice that we're using 365. Okay, there will be times that you may see a 360-day year used in financial functions or financial formulas. That just depends on the business. For us, we're going to assume it's a 365-day, okay? But this is determined by the business or the bank. Okay, it's how they're going to calculate interest rate. So if you're going to have a 360-day year, your interest rate might be a little bit higher because they're going to get that money from you one way or the other. Okay, but unless you're told differently in this book, we're going to use 365. All right, so then we're just going to calculate that out. All right, so 5,000 times 10% times I did times 90 divided by 365 gives me 123.29. Okay, and make sure you're rounding correctly. Oh, you don't even see that. Make sure you're rounding it correctly to get that. Okay, so this is how much you owe just for the 90 days. If it had been a whole year, it would have been the full 10%, but we're not doing 10%. We're just doing a fraction of that. Okay. All right, so same thing on principal. This one was the $8,000 note. It was 8% interest, and it was 120 days. Okay, so 8,000 times 8% times 120 divided by 365 to 1041. Okay, so now we know, we figured out when it was due, and now we know when we pay it back on that due date, this is how much interest we're going to have to add to our payback amount. All right, so now let's go back, because number 3 says that we need to use the maturity date we figured and the interest amounts that we figured to pay back these amounts on the maturity date. Okay, so first one we figured out was September 2nd. Okay, so the note's payable. We're paying it back. The check is number 345, and we're paying back the full $5,000 plus the interest. So this will be interest expense. Okay, and we calculated the interest expense to be $123.29. Okay, so those two items added together gives me what I wrote the check for to pay back that loan. 512329. Okay. Then the next one was, we figured out the due date was November 12th. And same thing. We're paying back the full amount. Note payable, so it was the full $8,000. And it was check number 652. Alright, and then the interest that we calculated goes along with that for 210.41. And then those two added together is the amount of the check. 8210.41. Okay? And then on December 31st, it says we paid cash on the line of credit, $1,500 principal, and the interest amount was $138 for the month of December. So basically, it's like in every month we're going to pay some of that back. So we keep our full line of credit. Alright, so December 31st. Line of credit. It was $1,500. We'll check 887. Oh no, not $1,500. Paid cash on it. Let's go. 500. I was looking at the on your own. 500. And the interest is $46. So we wrote that check for $546. Okay, to take care of that. And that is pretty much everything for 8-1. Like I said, pretty straightforward. We're borrowed. We calculate the due date. We calculate the interest. Pay it back with interest on the due date. All right, there you go.